Yes, my name is Mark Fitzgerald. I head up research here at Affinius Capital. We are a private real estate manager with over 60 billion in AUM across both the US and Europe, and play up and down the capital stack. No, it's a great question. I think it's interesting. Historically, what we've seen is that real estate valuation resets tend to be coincident or trail an economic downturn, whereas this time we've had the valuation and supply reset ahead of an economic recession, if you will. And so I think from a big picture perspective, where our valuations today, if you look to the public REITs, values are down about 16% from peak levels in late 2021. In the private real estate sector, using the NCREIF NPI as a benchmark, valuations are down a little under 20%, going back to the middle of 22. So of course, there's a lot of variation across the property sectors, and that gap differs, given the different mix by sector for public versus private, and we see cap rate spread differentials across the public and private space that are would imply still wide valuations, particularly industrial multifamily, maybe 25% on the industrial side, 15% for multifamily. So I think that's one trend that we continue to see is, where the private or the public markets are still a bit of a discount. I think from a overall valuations perspective, 2025 largely saw us in a holding pattern. There were fits and starts with what happened in terms of activity picking up before Liberation Day. I think we've seen an increase in activity lately as well. But across 25, US and Europe in the public markets, valuations are relatively flat. In the private markets, going back to the middle of 2024 for the overall NPI index, valuations are flat. Historically, once you have seen that flattening, barring another exogenous shock, it does tend to bode well for future valuations. And, you historically see a pretty strong turn upwards following those periods of flat valuations. We recently published a white paper on the impacts of inflation on the real estate sector. I think the first piece of that was really just furthering the existing research. There is historically a very strong relationship between inflation levels and changes and real estate performance. I think it makes sense, but when you see rising inflation, you tend to have the ability to push rents and NOI further, and it also, lifts up the underlying inputs to the construction process as well as construction labor, and so you see replacement costs rise as well. So it serves as a relatively strong inflation hedge, particularly if you compare it to, what happens in the fixed income space where you have, valuations and cash flows that don't adjust for that inflation. And so what the paper really explored was one, just to kind of, again, reinforce that dynamic, but also look at, okay, given the, concerns around where inflation is today, what should that imply for real estate pricing and cap rate spreads in the current environment? So I think if we look, given what's happened, with the trade policy situation, given what's happening currently in the Middle East, there are some factors that are placing upward pressure on inflation overall. And if you look to both inflation expectations are elevated currently, and the one-year inflation levels are now, about 130 basis points above their 25-year average in terms of where expectations are. Trailing inflation is also elevated. So we ran some regressions to determine where we think cap rate spreads would be today, or should be today, given those inflationary pressures. And so if you look at, I think a typical benchmark in the real estate space is looking at, the overall NCREIF implied cap rates relative to BBB corporate bond yields. And over the last 30 years or so, the average spread has been 14 basis points. Today, it's negative 45 basis points. So you have an almost 60 basis point gap from historical norms. And I think that's created a lot of consternation around where valuations sit today. But if we look to, use those inflation expectations and trailing inflation to inform, why cap rate spreads should potentially be tighter. If you look at forward-looking inflation, it would suggest that, cap rate spreads today should be around negative 20 basis points. So that kind of explains about half of that gap. If we look at trailing inflation, which I think is another measure for where investors think inflation should be, that actually explains 2/3 of the gap. So I think if we look to the inflationary hedging aspects of real estate, it does, suggest that, the market is not that efficient, and it does explain some of the, pricing discrepancies that we see in the market today. Yeah, I mean, I think like we just discussed, I think from an inflation perspective, it suggests that part of the reason for the tightness in cap rates today is that, investors are expecting higher inflation, but also uncertain around the distribution of outcomes around inflation. So that's part of it. I think we've also done, we have another white paper we published recently that was looking at the historical relationships of cap rate spreads and relative performance across asset classes. So we talked about, that triple B real estate private cap rate spread to triple B corporates. Part of the reason that is so widely used is if you look at where that spread sits from an entry point perspective, and then the going forward 5-year returns after that entry point, there's a very strong relationship between the relative yield spread and the forward-looking performance spread. So the wider cap rate spreads are priced to the triple B corporate, the better real estate tends to outperform. And so that is something that has, again, given people some pause compared to for where they sit in the current environment. But if we broaden that out, and what the paper did was really look at across other asset classes, both high yield bonds and the S&P 500. So we ran that same analysis compared to the earnings to price ratio for the S&P 500, and based on that measure would actually suggest significant outperformance for real estate relative to both U.S. stocks and high yield bonds. So I think that context is important. It's not surprising. We have seen private real estate valuations, as I mentioned, fall about 20% over the last couple of years, while the S&P 500 is up over 90%. So entry points for real estate are looking relatively more attractive, and I think that's really what that white paper was delving into. Yeah, I mean, I think maybe I covered that in part of the previous answer, but yeah, if we look today at where S&P earnings yields sit, they are very low compared to historical levels, and from a cap rate spread to earnings to price ratio spread, that's looking fairly attractive for real estate entry points, and would suggest that private real estate would outperform the S&P 500 over the next 5 years. Yeah, I mean, I think the core message is, we've spent a lot of time as an industry focused on have valuations adjusted quickly enough, and where do valuations sit in terms of entry points today that I think relative to some traditional benchmarks would suggest they're still fairly tight. But I think if we broaden that out, and certainly the impact is different across various property sectors, with industrial, still being fairly low cap rates as a standout, I think. But as we broaden that out and look across, one, given the inflation dynamics that we have seen recently in the market, and with a fracturing global economy and some policy shifts, what that could imply for future inflation. I think the relative real estate pricing and how it serves as an inflation hedge makes the asset class more attractive on a go-forward basis. And then also, broadening it out to compare it not just to investment grade bonds, but also high yield bonds and S&P 500. From that perspective, entry points for private real estate, even for core pricing, are looking particularly attractive today. And our research would also show that as we sort of hit the other side of this valuation cycle, over the last couple of cycles, and we've seen, we're going to see the supply pipeline, particularly for industrial multifamily, come down pretty substantially over the next couple of years. Historically, that has boded well for the relative performance of modern Class A product, both in the logistics and residential sectors. They tend to outperform in those first 5 years of recovery, given less competition from declining supply. So I think for managers that are able to, either hold that product or deliver that type of product early into the next part of the cycle, could see some relative outperformance there.